Well, we talked about the jobs report. What's behind today's numbers, and do they signal a turnaround in the jobs market and the economy? My guests are Jeanne Branthover of Boyden Global Executive Search. She specializes in hiring and retaining top executive talent. We're also joined by Standard Chartered economist David Semmens, who's ranked a Bloomberg Best. Both of you, thank you so much for being here. Now, something I want to focus in on the jobs report today is the average hourly earnings, which really have remained stagnant over the past 6 months. They didn't rise from February to March. David, let's start with you. I mean, what does that tell you when you look at the jobs report? The numbers going up, but what's the quality of the jobs that are out there?
It's showing that the jobs that are being created are on the lower end, and they've actually been pretty static. We've seen year-on-year growth around 1.7% really for the last 12 months now, and it's the fact that it's been completely flat for the last 2 months that definitely going to see people being concerned. Now, overall income for the economy has risen because you've seen more jobs being created, but the people whose jobs are being created are not seeing the wage increases that people are accustomed to, because people tend to expect that their wages will rise.
And Jeanne, what are you seeing on your end? Because obviously you're dealing with higher end jobs.
Right.
Are you seeing those pay scales sort of go up, or are they also remaining stagnant?
What we're really seeing, and it's really in financial services, it's a war for talent. So what we're seeing is really very different than we had been seeing. People before were moving for laterals or for less just to, get a better job or get a job. Now it's really people are moving jobs frequently, once again, because they are open to taking a risk, because they don't feel comfortable that anything's safe anymore, but it is for a lot more money.
And they don't necessarily maybe feel loyalty to the place where they are.
There is very little loyalty anymore. In the past, you saw people stay for years and years, and literally we even see people now that have been somewhere for years, 25 years, quickly moving, and that didn't happen ever in the past. So nobody feels safe where they are, and nobody has the loyalty that they used to have.
Well, it's interesting what you're saying, too, about wages on the high end going up, because that would seem to indicate, to your point, David, that actually on the low end, maybe they're even going down. I mean, if you have if you're talking about it all averaging out.
Yeah, I mean, it's more that they're staying flat. I mean, people have a great resistance to actually lowering their wages. You might cut someone's hours, but you don't tend to lower their wages. And so that's really what we've been seeing. But when you're saying about people being loyal, what you're also seeing is the long-term unemployment is the real problem here. People who have been long-term unemployed, it started rising again as a proportion. That's because people aren't getting fired in the same way, or the people who are getting fired are getting hired again quickly, and those who are unemployed are now remaining unemployed for longer than 6 months. And that's a real problem, because people lose their skills, they become discouraged and leave the workforce.
I mean, Jeanne, from your perspective, what do you think people are waiting for if they've remained out of the workforce, the folks that you're dealing with, to get back in? Is it that paycheck, or what are the qualities they're looking for?
A lot of things, and we're seeing that. People actually, when the crisis happened, they decided to step out. Even at very senior levels, they were, they didn't want to deal with it. It was very hard to make money. It was very hard to generate revenue, and even if you're terrific at your job, you weren't able to do it. So people actually stepped out. Now we're seeing them come back in, and they're coming back in because the money's there again. People had been working very, very hard for less money, and a lot of people at senior levels said, you know what, I've done well, I don't want to do that, and now they're coming back, and they're really getting back into the workforce. But what we're seeing that they're coming back for is not just about the money. The money is really something that if you're at a senior enough level, it comes. It's really about they can make a difference after the crisis, because people are able now to generate revenue again. They are creating new product. They are bringing in technology and spending money again. So you're really seeing people very excited about coming back and creating and building and really going to another level with new things and new ideas.
I mean, obviously this is highly anecdotal, what Jeanne's talking about, but is that also encouraging from a larger jobs market point of view?
It is, but what Jeanne's talking about is a massive leading indicator, whereas when you look at the broader labour market economy, you've got the participation rate staying at 64.2, and that's showing that people just still are very discouraged. That's one of the reasons why the unemployment rate has come down. We're not looking for the unemployment rate to come down quite as quickly going forward, simply because we hope that these figures will start encouraging people. And we're looking for similar sort of numbers going forward from payrolls for the rest of the year. We're looking for around 250, 300,000 for the rest of the year, simply because the tax stimulus that the government provided for equipment is going to really stimulate spending in that area, which then brings jobs. So
what tends to be historically sort of the lag between the upper end of the job market recovering and the mid to lower end of the job market recovering?
It's anything from 6 to 12 months, depending on which recession, but unfortunately it seems to be taking longer, if anything. Now, you are seeing financial services having turned around probably for 12 months to 18 months. I'm sure Jeanne's perhaps got a slightly better take on that at the higher end than I have, but you are still not seeing an incredibly strong turnaround. Given the depth of the cut we've seen, we should be seeing much stronger payroll additions, and we simply aren't seeing those.
Now, something else that we talked a little bit about is if wages broadly are stagnating and prices for things are going up, I mean, isn't that going to, even if the jobs market continues to improve, isn't that going to put pressure on spending and on the broader economy?
Exactly. That's why we saw consumer confidence take a hit this month, simply because people are concerned about the outlook with regards to wages and oil prices. But it does feel like energy prices, if they stay at this level, then you'll see a transitory effect on inflation, and so it won't be such a big hit. Is if you have a slow and steady increase in energy prices, that then you still see people's real income really start to fall.
And Jeanne, just quickly here, what are you hearing from your clients in terms of inflation? Is it something they're worried about, or because the job market is getting better, it's not as much a concern?
Well, they're worried about how they're being paid to be able to afford if there's inflation or any kind of increase in spending their money. And the reason is because so much more of the compensation is deferred than it was in the past. And so someone who's, making big money, they're getting it paid in the future, and it's a worry.
Okay. Jeanne Branthover, thank you so much. David Semmens, thank you so much for our Jobs Roundtable. Interesting insights here.